Naked trading is simply trading virtually indicatorless so that you can see in real time what's going on with your current price without hiding behind a mess of indicators. And it's better known as price action trading, where you may trade candlestick chart patterns or even singular patterns such as a pin bar. And there's one particular naked trading pattern that I like to use, and that is what is called a failure test, which looks to take advantage of traders trapped in an adverse position. And without the use of indicators, some may say that naked chart trading is highly discretionary. And while there is some discretion, obviously it's involved, you can set up a trading strategy that's rules-based so you are not trading patterns in clouds. You will have actual variables that you're looking for that should be contained in your trading plan. And if your first instinct is to check out an indicator in your chart for a trading decision, you are already a little late to the party since most indicators are a derivative of price. And that's not to say that indicators are worthless, but they should not be the main driver of your trading decisions. Trading indicators can add value in certain circumstances, such as finding a consolidation during a quick scan. This chart here, it shows two moving averages, and during a scan, either you programmed it or it's visual, it can highlight you to a potential trading opportunity. You could see the same thing with a naked chart, but this is a fast and simple way to scan many instruments at once using a technical indicator. And as a side note, notice the breakout from the consolidation, which made for a really great trading opportunity, which you saw when the moving averages converged. Now, markets alternate between trending moves and price compression, and there are opportunities to be had in both states of your market choice. When markets are trending, you have the opportunity for continuation moves or trend termination trading plays. Once the markets find a consolidation area, you now have the opportunity to play a support or resistance holding or failing play. 4 types of trades, and there are literally hundreds of ways that you can take advantage of these trading opportunities. In this chart here, there is a move that we see time and time again because it is just the nature of the markets. What occurs here is during the markup phase, that big green candle, it attracts the eyes of traders who jump into that move. These traders are actually late to the party because more astute players are in the move prior to the break. And you'll notice in the accumulation area, immediately prior to that break, we have price setting up against resistance in a 2-candle range. Now this is an opportunity for a trade where you think one of two things can happen. Resistance will hold and you play a short right back into the consolidation. Resistance will fail and price is going to rally to the upside. While some traders will use a rate of change indicator or something else to show momentum, you can actually drop to lower time frames and see what the actual price on the chart is telling you. Now these moves happen on every time frame, whether you day trade, swing trade, or you look for position trades. These are viable trading truths that you can actually profit from. And you can also drop to lower time frames and see what type of structure is playing out in that time frame. Is it more bullish, indicating a higher probability of a resistance fail? Is price starting to put in upper shadows and lower lows, indicating that the bears have control? We can also look at the current chart and gain a rough idea of how the lower time frame played out in the move just before the break. On the left side, we have a trading channel, and at the bottom, we have what could be considered a failure test of the lows of the channel. And we would consider that a bullish sign in this context. On the right side, I've drawn what I thought the lower time frame would look like. Price has put in a bullish structure as well as an unconfirmed higher low and a double bottom. Given the bias is to the long side, is it a worthwhile play to get a trade on prior to the potential break of resistance and mitigate risk with a protective stop? And I did write about this type of trading in a blog post called range trading. You can see that here. While it's possible to use multiple time frames in your trading approach, you can infer a lot from even a daily candlestick. This example is a daily uptrend, and we are in a strong momentum market condition. Now, these can be difficult to enter at times because there's no pullback, or is there? Understanding naked chart trading will require you to be able to infer lower time frame price action by the higher time frame candlestick. And this is the sign of an accomplished price action trader where they can see the intraday price movements inside the daily candlesticks. And in this example, price does pull back on lower time frames as indicated by the lower shadow of the candlestick. Now, of course, we don't know the exact route that price took to close above the open, but we do know that price pulled back. Placing an order near the market close or a buy stop slightly above the high, it's a high probability play. The market is moving with momentum. Price did work off some of that strong move with a pullback, and the close of the candlestick indicates lower time frame breakout success. Now, you're not going to buy the bottom. If there was an obvious lower time frame reversal bar, your trading plan here was end of day trading to free up your days for other things. After price breaks out, breakout traders and those waiting to see bull interest pile into the trade. Is it overbought? Is it oversold? At this point, it doesn't really matter. Using just a naked chart, we have a level of resistance sitting above current run in price. Now, this doesn't mean that price is going to fail to continue, but it does mean that we should be on alert to what price does at this level. And this applies to both support and resistance. And these are areas you look for price action to show signs of what you're going to do. Now, being on alert and having the ability to read the forming structure can give you a profit exit long before everyone else rushes to the exits. Traders will pop on oversold, overbought indicators, momentum indicators, or some other derivative of price, but they're going to fail to watch the price action unfold and what it will leave behind. And a key point, when I say price action, I am referring to the action of price, but more importantly, the structures it leaves behind. And after the big candle here, we see some reversal candles setting up in the area of resistance. Notice the long shadows on those two candles, with one being longer than the other. Traders were still buying, even though it was a resistance area and long top shadows were being printed on these candles. Price fails and there's another push up towards resistance, but you can see the structure that's printing does not point to bull strength. And after a period of sideways action, we see a final spike in that white box into the resistance level, and the bottom just falls out. If those longs didn't bail, they're in serious trouble here. Now, there was no reason to hold on when it was obvious that the move was in trouble long before price broke to the downside. And here's a note from Seykota. The elements of good trading are cutting losses, and cutting losses. And if you can follow these three rules, you may have a chance. Now, once price broke into the top range, what would you expect to happen for an up move to continue? Increase buying. But what do we get? Price range with higher bear interest than bull interest. Is that conducive to a sustained up move? No, it's not. And that's not to say the second range could not resolve to the upside, but we can only work with what we have at that present moment. We do not need a trading indicator to tell us what has and has not occurred at this level because we can see it. So what does that give you? It gives you a reason to exit your trade, and depending on your trading personality, a chance for a trade in the opposite direction. We know exactly where we would be wrong on a short, so our stop is pretty easy to place. You are selling pretty much near the top of the move and catching the move down from an advantageous place. And you can tell a lot more about the state of the market by simply looking at price and the structures that it plots by using a naked chart. The Japanese candlesticks gives you an inside view of who is doing what at each point in the chart. Understanding how the candles on your time frame plot on the lower time frame can give you insight into who is gaining the upper hand at most times. Take a look through your charts and see where what you expect to happen, as shown in the image that we just looked at, doesn't happen, and how you can capitalize on a higher probability trade and entries to pick up some profits. Now, look, is naked trading the holy grail? Some marketers are going to attempt to sell you their secret sauce, but in reality, there isn't one. It's also not the only one way to trade. There is nothing inherently wrong with trading indicators, but it's the use of the indicators that's the problem. It is the failure to understand what the indicator is telling you. For example, I often use a variation of trading bands to help scan for overextended markets that may be ripe for support, resistance, failing type of trades. It's also a precursor to a reversal trade. I will use a momentum indicator to also make it easier to spot momentum that's decreasing or increasing. A trading setup will depend on the context we find ourselves in. In the end, though, it'll be the structure of price that you can see on a naked chart that will determine if a trade is going to be placed, and the indicator information is supporting the decisions.